My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now. Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramerica. I'm doing my friends, just trying to make a little money. My job, not to entertain, but to educate, teach you. Call me, 1-800-743-CBC. Tweet me, Jim Cramer. Never get tired of all-time highs. We're experiencing a pretty terrific time for the market.
House of pleasure.
Which is exactly what I said would happen when the Fed starts cutting rates while the economy's still solid. That's how you get days like today. The Dow gained 410 points, all-time high. S&P climbed 0.61%, also an all-time high. And the Nasdaq advanced 0.33%. Take what happened today. Some of the major banks reported this morning. The numbers were just, frankly, spectacular. This has happened before, but because the Fed was in a tightening cycle at the time, the good news just didn't matter. Now, though, the Feds are Fed, so we can extrapolate better times. That's why the strong earnings from Wells Fargo, JP Morgan, and BlackRock were greeted with such a resoundingly positive reaction. You know, it wasn't like that early morning when the companies reported. JP Morgan stock was initially unchanged. Wells Fargo stock was getting hammered mercilessly. Although BlackRock's numbers were so extraordinary, there's no way its stock could give up any ground. But once we heard the conference calls from JP Morgan and Wells, we realized, wait a second, maybe the best is yet to come. And then we were off to the races. Maybe that's going to be the pattern of this nascent earnings season. Oh, we're going to find out soon enough. Next week, the numbers will be flying in, and we'll be, if we see if today's positive action can be sustained. Which brings me to our game plan. Now, on Monday, we won't be focused on earnings. There's a lot of other stuff happening over the weekend. For instance, I think we'll be parsing the Chinese stimulus package that's got to be unveiled. The China rally is stalled, but it can get rolling again if the Chinese Communist Party keeps throwing tens of billions of dollars worth of stimulus at real estate, at the stock market. Now, I have blessed buying Alibaba, the Chinese Amazon, and Baidu, the Chinese Google. But those are the only two I can countenance up here. They have trustworthy financials, very good balance sheets. By the way, they're not all that expensive. We'll have a very big test for the financials on Tuesday because Charles Schwab, Goldman Sachs, Bank of America, and Citigroup will report. Schwab's one of the largest retail brokerages in the country, but its last few quarters have been greeted quite poorly. Bond portfolio issues, arcane issues involving cash sweeps. I think these problems are past tense, and this situation is compelling. But I feel very lonely. Maybe this is the quarter where people will finally look at the future and how fabulous Schwab's franchise really is. I can't be sure, but they should. As for Goldman Sachs, where I did work at one point, I'm thinking it's going to blow away the numbers and the stock goes higher. Bank of America caught a big break today. Warren Buffett has sold so much Bank of America stock now, he's under 10%, where he no longer has to report that every time he sells stock. Well, that'll help the stock immensely. Why? Because it wears you down to see that Warren Buffett sold some shares every few days. You never want to be on the other side of a Buffett trade, right? That said, Bank of America might have borrowed some of the upside today for next week because it was up 5%. The street's fallen in love with the stock of Citi. Rather amazing. Under the leadership of Jane Fraser, sometimes I think she could say anything and the analysts will praise her. She's turning Citi around, though. Not an easy task. Hard to remember the last time I saw so much confidence in this institution. I don't share it yet because I like so many of the other banks. Now, but next week's not all about banks. We have United Health Group, and this Dow component just doesn't miss. UNH is the only health insurer that regularly beats earnings. Nothing's clockwork in this business, but when this one misses, the stock barely goes down, and when it beats, the gains are huge. Interesting risk reward, huh? Hey, speaking of healthcare, Johnson & Johnson caught a huge break in its talc lawsuits this week. A federal judge has allowed a prepackaged bankruptcy to plan to contain the damages, and it's being held the case in Texas, much more friendly than New Jersey, where a lot of people felt it might be. Is it the beginning of the end of J&J's multi-year legal overhang? Could be. That means we can finally start focusing on earnings again, and when we get those earnings, especially for the pharma business, I actually think we're going to like what we see. We probably won't like what we see when we get the numbers from Walgreens, though. But the bar's so low with this drugstore that maybe it won't even matter? Yeah, it's been that bad. My charitable trust owns the two big stocks on the Wednesday docket. That's Morgan Stanley, the big brokerage firm, underwriter, and Abbott Labs. Morgan Stanley was a real headache for a while as the bears kept tearing apart their wealth management business. Not anymore, though. Ever since Ted Pick came in as CEO at the beginning of the year, we've seen buyers swarm in on any weakness. Stocks had a big run, but you know what? It still yields 3.3%. I say hold on for the ride. Abbott Labs is mired in litigation, too, this time for a specialty baby formula that plaintiffs claim causes grave harm or even death for their infants. But last week, the FDA NIH, and CDC came out and they said they found no linkage, no conclusive evidence that Abbott's formula causes the illness. Abbott lost a case not that long ago for a huge amount of money. It's litigating another one now in the same venue. I think it could lose that one, too. But the FDA, NIH, and CDC comments could potentially turn the tide in Abbott's favor going forward, which would be worth a great deal to this $116 stock. Now, please don't forget, I'm going to go over these two. When I see myself there, it's a little awkward, but please don't forget this guy, okay? Well, yeah, because we have our CNBC Investing Club meeting at noon on Wednesday. We have 2 initiations. Chef Mark's going to be awfully busy and a host of things to say about the fourth quarter. You'll want to watch. I promise to keep it rolling. Thursday, Taiwan Semi reports. What can I say? This is the company that manufactures NVIDIA's chips. The stock's been very, very strong, really ramped today. Calls basically in the middle of the night because of the time zone difference. Don't worry, I'm going to set the alarm and I'm going to listen. No, forget the alarm. I just won't go to sleep. After the close, we get results from Netflix, and the street's been all over the place on this one. I think it'll be good thanks to the new ad tier, and they're about to release Squid Game 2. Is that like Squidward? Is that like SpongeBob? I don't know. I'm told it's going to be a guaranteed worldwide blockbuster. It could bring in new subscribers from around the globe, not as creepy as SpongeBob. Finally, Friday, we hear from Procter & Gamble, and I fear what they're going to say about China. Last quarter, their Chinese numbers were terrible. I don't know if they can change that in just 3 months. The stock went up to 171 today. That worries me. I think it's too high. We sold the stock for the Travel Trust this week. I think there are better places to be. SLB reports, and the old Schlumberger just hasn't been able to catch fire despite the bounce in oil for the last 2 weeks. Sure, it's up high single digits on a percentage basis, but the number one oil service companies had a tough time because the Saudis keep saying that oil prices could be low for long. And you don't want to go against the Saudis. Finally, here for one of my favorite companies, American Express. The last 2 times it got hit, I told you to buy it. That was right. Maybe the third time's the charm and it won't even go down. The Amex conference call is a great affair because the company gives you so much information about who's spending, what people are doing, Gen X, Gen Z. They got it all. If you monitor this one, if it gets hit, I'm going to tell you it'll probably be a buyer. It's been right, and I'm not going to change my view. Here's the bottom line. We're at the beginning of one of the year's 4 reporting periods. Probably, I told my wife today, the most exciting. I can't believe that I still get fired up for this, but man, do I ever. They're jumbled. They're open to a lot of invitation. They're fast. So listen to the calls. Ponder a moment, and only then should you pull the trigger. Marcus in New Mexico. Marcus.
Jim, how's it going, man?
Man, I'm telling you, I'm just coming in hot. How about you?
I'm coming in hot as well. I'm sorry about your Phillies. I hate to see them go out, but I think the 76ers are going to make you happy this year in basketball.
Well, I used to be a I sold Cokes and ice cream at Vet Stadium, and I love the Phillies. My mom and I love to listen. That's what we did together. How can I help you?
Yeah, the stock I'm calling about is VRTX, Vertex Pharmaceuticals. I know there's a lot of hype around the AI healthcare megatrend. I know Jensen Huang, the OG, is super excited about it, as well as some other CNBC contributors. And I just wanted to know if Vertex was a quality company to play this megatrend. Okay,
the big thing you need to know about Vertex is what it comes down to is whether their anti-pain drug is both, 1, not habit-forming, and 2, no side effects. And I've got to tell you, I'm a believer in Vertex. I regret at 300, I got the call to buy that when I was at the Super Bowl. And I was with a doctor who just said, listen, Jim, you should be just in Vertex for your Travel Trust. And, you get these random things, people say it, and you write it down, and then you don't follow up, and you're the worst for it because readers and viewers of the stuff that I've written and talked about have made me more money than almost any other source. Let's go to Robert in New York, please, Robert.
Hey, Jim, it's a funny story. I was having a martini, a phenomenal dirty martini over at Toku in Manhasset. And I'm sitting at the restaurant, and the guy next to me says, what are you doing? I said, I'm calling into the greatest stock guy on Wall Street, Jim Cramer. And the guy turns around, he says, that guy's right 95% of the time. And this isn't made up. This isn't made up. This is 2 seconds ago, okay?
Tell that for you. Listen, 2 on me. Okay, let me give you my American Express card number. Here, just you put it up here. No, I mean, first, I got to thank you. You made my week. I mean, honestly, it's been a long, hard week. You just made my week. Drinks all around. Everybody. Water. You have a water, and you get a water, and you get a water. And a dirty martini, why not? Let's have a dirty martini. He thinks this is water, this guy. I love it.
Anyway, Jim, this company provides observability service for cloud scale applications. They have 28,000 customers. They have cash equivalents of over $3 billion. They've been beating every quarter with revenues through the roof. I think they're well positioned. You weren't that crazy about them in August. You said it's a good company. I don't know if I can trust them, but I think you can because they've been proving themselves. Datadog.
It is a good company. I have not liked Enterprise Software, but Enterprise Software caught a bid this week. Atlassian. There's some takeover talk. We know that MongoDB is very interesting. JFrog. If it's got a dog or an animal's name in it, I think people are just like, wow. But I will tell you, remember, it's Enterprise Software. It ebbs and flows. It ebbs and flows. And right now, it be flowing. And thank you. Tell that 95%er that just, I wish I were that good, but I thank him very, very much. And I thank you, too. We're just getting started with the earnings season, which you know I love. It's always open to a lot of interpretation, though. So make sure you do some homework before you do any buying. Make sure you have your models ready. You look at all the numbers and you say, I get it. Mad Money tonight. Last night, Tesla held its We Robot event, highlighting that some of the futuristic technology companies have been working on, but the stock fell in response. So I'm going to break down my key takeaways, sharing you what I took away from it. Then, you called in on Bellring Brands, and I had to do a little more homework on this one. I'm turning my homework in on the company behind Premier Protein and Power Bar. And regular viewers know I'm always preaching the importance of diversified portfolios. So tonight we're going to be playing Cramerica's favorite game, which is MI Diversified. See if your portfolio passes the test. And stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on X. Have a question? Tweet Cramer. #MadMentions. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.
Last night, Tesla had its long-anticipated We Robot event, the big unveiling event for their upcoming robotaxis. And as you can see from the stock's hideous 8.8% decline today, let's just say it didn't go over well. Remember, Tesla needed a win here. Around the middle of last year, Wall Street realized that there just wasn't as much demand for electric vehicles as people thought. EV growth started slowing across the whole auto industry, and Tesla in particular just got clobbered as it faced all sorts of new competition for a more slowly growing pie. Hey, some of these new electric cars from China are incredible and very reasonably priced. Tesla actually saw its delivery shrink for the first 2 quarters of the year. And they were only up in the third quarter because the company was lapping a bad production quarter from the year before. And that's why the stock lost more than half of its value from July of last year through this April, when it bottomed to 138. What happened in April? Elon Musk changed the conversation. Even though Tesla reported a disappointing quarter, Musk very effectively pivoted to talking about self-driving cars. And it all hinged on this robotaxi event. That's the whole reason to own the stock here, I think. Something Musk flat out admitted on that first conference call. That turned out around the stock for a while. People liked it, okay? In fact, it nearly doubled in 3 months. I got excited about it, too. But when Tesla reported another weak quarter in July and announced that the robotaxi event was delayed to October, the stock went into another tailspin. Of course, it bottomed again within a month and then started ramping. That move was all about anticipation, not just of the robotaxi event, but also for a rate cut cycle from the Federal Reserve. Unfortunately, when the We Robot event finally arrived, the market just was not impressed. Sure, anyone who watched this thing has to admit, this thing was visually stunning. We were mesmerized by it in the office. There were 3 main pieces of hardware that debuted last night. First, there's the robotaxi itself, which Musk calls the Cybercab. Good name. A sleek 2-seater coupe-like vehicle with gull-wing doors and a clean, simple interior. No steering wheel or pedals. Only 2 people, please. Crucially, Musk said the Cybercab will cost less than $30,000, so that small business owners can buy whole fleets of them. He took a little ride in one of these Cybercabs around the Warner Brothers lot to kick off the event, and afterwards, attendees had a chance to ride in it. Pretty cool. Many came away quite impressed. Of course, there's nothing truly surprising here. The surprise, though, was a new van or bus-like vehicle that Tesla's calling the RoboVan, which can carry up to 20 people and also transport goods. Very Art Deco. This is what we thought the future would look like when I was a kid, which was 100 years ago. Finally, the coolest piece of hardware we saw last night was Tesla's humanoid robot. This I love, okay? Orally called the Tesla Bot or Optimus. Now, we've seen these things before, but it's always cool to see the latest generation of these robots. Last night, they were dancing on stage, serving drinks. They were even having some pretty good conversations with people. Musk reiterated that these Optimus robots will be for sale at scale and would cost around $20,000 to $30,000. He said that Optimus could do, quote, anything you want. So it can be a teacher, babysit your kids, it can walk your dog, mow your lawn, get your groceries, just be your friend, serve drinks, whatever you can think of, end quote. I don't know, I can use one of those. My wife's mad at me, and I'm like, hey, I'm going to kill some time when she's playing Candy Crush. Again, visually, all this was stunning. Musk really put the vision in visionary. But what about financially? Oh, really? The finances? Okay. Look, Tesla's a big problem. The electric vehicle market turned out to be substantially smaller than most thought. If they want to pivot to self-driving cars, they need to really flesh that out. And last night, we just didn't get much in the way of specific details. One of my favorite analysts, followed by the name of Morgan Stanley's Adam Jonas. And someone had been a big Tesla fan, but he published a reaction note to We Robot, and it was titled, this was really, I saw this morning, it said it's going to be a long day for this guy, for Tesla. This is disappointing lack of detail. And here's the issue. It's very hard to get self-driving technology to work right. And it's even harder to roll it out because you need to get local governments on board. And the moment there's a single accident, all the politicians panic. Now, Musk said that a full autonomous version of Tesla's driver assistance system would be available in Texas and California next year. That's a genuine positive. Remember, Austin's got it. And by the way, Atlanta is going to have Waymos. But when he was asked about the robotax timing, the answer was underwhelming. You got to listen to this. This thing is really jarring.
We expect to be in production with the Cybercab, which is really highly optimized for autonomous transport in probably, well, I tend to be a little optimistic with timeframes, but in 2026. So, yeah, before 2027. Let me put it that way.
Needless to say, that didn't inspire a lot of confidence. And there was no timeline at all for the other stuff, including the robots. Not many people can get away with what he just did. And because he's a genius, obviously, we're going to look the other way. But that was not good. Worse, there wasn't a lot of substance to the demonstration. It's not that hard to make a self-driving car do a predetermined loop around a closed course at a Warner Brothers lot. I personally believe that Tesla self-driving tech is pretty good, but they didn't do much to prove it last night. This is especially important because Google's Waymo has a full fleet of unsupervised autonomous taxis running revenue-generating routes in San Francisco, Phoenix, LA, and Austin. We were one in San Francisco. I thought it was fantastic. Plus, beyond Musk's very broad commentary on pricing, there was little to no detail on the economics at last night's event. Musk gave some info about some average operating costs of the Cybercab, saying it would cost 20 cents per mile run, with customers paying 30 to 40 cents per mile. Now, if that's true, the Cybercab does indeed have a major cost advantage versus Waymo, which uses more complex and expensive LiDAR systems for its self-driving technology. And Musk also claimed that the Robovan would have average operating costs of 5 to 10 cents per mile. But he didn't give us any evidence, so who knows whether these numbers are accurate or not. At the end of the day, the market's reaction tells you basically all you need to know. Let me put it this way. Not only did Tesla stock almost drop 9%, but Uber, which faces an existential threat from robotaxis, actually saw its stock rally nearly 11%, climbing to new all-time highs. Wall Street clearly doesn't have much confidence that the Cybercab will be viable anytime soon, or obviously, we wouldn't see Uber stock roar like that. And without the self-driving kicker, Tesla's back to being an automaker that went all in on the decelerating electric vehicle space. All that said, I've been following Tesla for a long time now, and historically, the best time to buy is when everyone's doubting Elon Musk. We know from discussions with NVIDIA's Jensen Huang that Tesla's invested a lot of money in the type of infrastructure that you need for artificial intelligence, a neural network. At the end of the day, autonomous driving is just AI. So even though I definitely wouldn't be a buyer after the robotaxi event, I wouldn't short Tesla either. Even if you don't want to bet with Elon Musk, it's way too dangerous to bet against him. Here's the bottom line. Even though Tesla's robotaxi event was gorgeous, we didn't get enough detail to justify treating this company like an autonomous driving business rather than an electric vehicle maker. So for now, I recommend taking a page from Switzerland and stay on the sidelines with this one. There's just not enough specifics to hang a hat on. Mad Money is back after the break.
Coming up, is this company the belle of the ball? Cramer gets his reps in on a power stock that's packing the protein. Next.
Before we get bogged down with a flood of companies reporting next week as earnings season goes into full swing, I'm turning in one last homework assignment. Last week, Eric in Utah asked me about bell ring brands, and I told him I need to do more work before I could opine on it. This is a nutrition products maker with a big portfolio of ready-to-drink protein beverages. This thing was originally part of the active nutrition business at Post Holdings. That's the iconic packaged food company. Now, nearly 5 years ago, Post IPO'd a minority stake in Bell Ring Brands in order to unlock value. This was a growth division that they figured would get a higher multiple as an independent business. About 2.5 years ago, Post spun out Bell Ring completely by distributing its remaining stake to Post shareholders. And since then, BellRing's IPO, October 2019, well, stock's up more than 350%. And just since Post completed the spinoff in March 2022, it's giving a 150% return, and Post up more than 70%. That's why, look, I love breakups. Luckily for you home gamers, and me too, since it's a Friday, BellRing Brands has an incredibly simple business. Like Eric in Utah told us last week, BellRing sells various nutrition products. Their two big brands are Premier Protein and Dymatize, with roughly 80% of the sales coming from ready-to-drink protein shakes and the rest coming from protein powders. There are some recipes for this stuff on their website, although I'm not sure I'm ready to make the leap to chocolate protein pancakes. Maybe Sunday. Everyone's got an eye on the protein drink business now because of the GLP-1 weight loss revolution. These drugs can cause just about anyone to lose enormous amounts of weight. But the problem is you're not just losing fat. You're also losing muscle. Now, if you don't want your muscles to atrophy when you take this stuff, you need to consume a tremendous amount of protein. BellRing shakes and powders are some of the most efficient ways to make that happen. You could just eat a lot of meat, but the GLP-1s make it harder to really gorge yourself on any food. So you need a shake. On the other hand, BellRing's largest brand, Premier Protein, which made up 83% of their sales this year, has ready-to-drink protein shakes in 14 flavors, including 3 seasonal flavors like pumpkin spice. Hard to resist at this time of the year, isn't it? These shakes contain a whopping 30 grams of protein. That's 60% of the recommended daily intake. And you get all that with only 160 calories and a gram of sugar. This business is on fire right now. According to management, Premier is the #1 brand in the ready-to-drink protein shake business. By the way, there may be 7-8 million people on these drugs. They need this. BellRing says this brand already has 19% household penetration, up from 16 last year. Management notes that their growth is driven by consumers who are new to the category. And again, I think many of these people are taking GLP-1s. Combine that market penetration with the growth we're seeing in the category, and there is a lot to like here. BellRing's other big brand, Dymatize, is more targeted at fitness enthusiasts like Christian McCaffrey, who's a spokesman for the brand. And by the way, the practice winner did it over him this weekend, so sorry. Lots of hardcore protein powders here. Now let's get down to brass tacks. How much of the company's growth comes down to GLP-1's weight loss drugs? Last quarter, while management didn't talk about GLP-1 specifically on the conference call, a TD Cowen analyst noted that in a callback with management, they acknowledged the adoption of these drugs contributed to roughly 100 basis points of incremental growth to the business. Nothing crazy, but it's a sign that GLP-1 protein thesis is real. Notice that BellRing's products are designed to help with weight management, not weight loss. That's probably why they had Christian McCaffrey. You know, you have a football player. You know, these guys want to take care of their bodies, and I sure hope he gets better fast. GLP-1s take care of the weight loss for you. The shakes just help you retain muscle. This is what makes these protein products so exciting. They're jam-packed with protein while not being too filling. The Premier Protein brand's approach to marketing as a lifestyle fitness brand, as opposed to a weight loss enabler, seems to be paying dividend, while competitors like SlimFast are falling behind. Plus, you can get a 15-pack for just over 20 smackers at Sam's Club. Less than $2 per drink seems like a steal to me. Hey, it might be the only deal out there that can rival the Chili's 3 for Me. We do like that one. So how do we value this thing? Look, while I'm excited about the easy protein plays with GLP-1 exposure, it's not like this is a new thesis. People started speculating about this one over a year ago. Yeah, it's like I was late to this. In this business, companies tend to skate to where the puck is going, meaning there's real competition brewing here. It's not like BellRing has this whole space to itself. In fact, they're fighting for market share with some heavy hitters. I mean, you know, there's like Fairlife that makes Core Power branded protein products, but more importantly, Fairlife belongs to Coca-Cola. Now, maybe you've heard of Coca-Cola. Just like BellRing's Premier Protein brand, Fairlife is trying to appeal to the lifestyle fitness demographic, and while Coca-Cola's distribution prowess should not be discounted, I gotta say BellRing has done a good job of getting their product in front of the consumer, too. Their biggest customers are Costco, Walmart, and Amazon. 3 bulls for that, right? Oh, one more, please. Those collectively made up about 75.3% of the company's sales last year. As one analyst from Jefferies put it, the category is still small enough that leaders in the space should be able to deliver outsized growth. Maybe Coke will start to gain market share with Core Power, but you're not getting a pure play on these protein shakes by investing in Coca-Cola, are you? And that's what makes BellRing so interesting. So where do I come down on this one? Listen, you've heard me talk about the revolutionary nature of GLP-1s. I always tell you to buy Eli Lilly, it's my travel trust, and how their users are desperate for protein. BellRing gives you a pure play on that, frankly, something you can't find anywhere else. Unfortunately, because it is a pure play on a hot theme, stock's gotten expensive. Currently trading at an all-time high, up nearly 50% over the past year, and selling for around 30 times next year's earnings estimates. Now, that's pretty pricey, given that Wall Street's only expect BellRing to earn about at a 10% clip. Typically, if a company's growing at 10%, I wouldn't be willing to pay more than 20 times earnings for its stock, not unless there was some reason to believe that the numbers are about to accelerate dramatically. Then again, this is a pretty unique story. Maybe someone like PepsiCo will acquire them to compete with Coca-Cola in the space, although they're not necessarily in the cards. It does explain why the stock could necessarily be up so much. Here's the bottom line. BellRing Brands has a great story. But if you like this one, can I please recommend that you wait for a pullback before you pull the trigger? Who knows? Maybe Coke will make some errant comments about protein when it reports in 2 weeks to take down the entire group. Either way, I say put BellRing on your shopping list and wait for a sell-off to give you a better price. And once again, I thank a fabulous viewer for a fantastic idea. Amy in Pennsylvania. Amy.
Hey, booyah, Jim. How you doing today?
I'm doing well, Amy. How about you?
I am absolutely awesome. I am so honored to be on your show, Mr. Cramer.
I'm honored to have you on the show. And our staff is too.
My husband, Eric, watch you all the time.
Oh, fantastic. I hope I can help you.
Yes. So my husband's been in stocks for quite a few years now. He gave me X amount of money a few years back and said, you know what? Pick one. So I picked McDonald's. So I've had it for about 4 or 5 years now. I'm wondering whether I should I keep it or whether I should sell it and try for something else.
Well, first of all, you've got a great American company. Second, I would not touch it. When the stock dropped to like 280, 290, I thought, you know what, this thing is going to be a rocket ship back. And then it went down a little bit more. And then the next thing I know, it has just soared. You caught a great run. Don't do anything. Just hold on to McDonald's. They got that $5 burger, and it is crushing it. How about Craig in California? Craig.
Mr. Cramer, happy Friday and a big, beautiful booyah chooyah.
Ah, you're so kind. Thank you. Thank you very much. Let's go to work. What do we have?
Okay, I've got a two-pronged question for you here. My stock is Walmart. I'm up huge on this bad boy, but I know I've got to trim it. I'm being a pig right now. My question is, do I simply take my profits off the table and let the rest run, or do I pivot out of Walmart? The second part of the question is, I'm looking at retirement right now, and I have a financial advisor saying I should take 50% of my equities and put it into muni bonds as I get ready for retirement. Is that the right strategy right now?
Okay, there are going to be people who have different ideas, and I've heard that idea, and I do like municipal bonds. Let me do a little bit of pivot. I always want to bet with myself, not against myself, which would mean I want you to have a long and happy life, and to do that, you have to have a little more equity exposure. I am probably to the unorthodox side of maybe doing 75% because I believe that we want to hope for the best, live for a long time, and I would feel better, and then 25 for the muni. Walmart, I wouldn't touch. It's a great company. Are you being greedy? If you're being greedy, take out your cost basis. But otherwise, if you ask me my advice on whether Walmart is a great company, all I can say is one of the best in the world. And I thank you for your confidence. And I think your advisor's doing the right thing. He's concerned. I have a different view. That's all it is, just two different views, both of which I think have validation. I think BellRing Brands has a terrific story. But if you do like this company, I recommend you got to wait for a pullback before you pull the trigger. Now, much more made money in. Is your portfolio built to handle whatever the market throws at it? You know it's not always this halcyon. I'm putting Cramerica's holdings to the test when we play Am I Diversified? Then I've always learned a ton from BlackRock's Larry Fink. And after speaking with him this morning on Squawk on the Street, I'm sharing his latest. I think it'll help you become a stronger investor. You know how much I care about that. And, of course, all your calls rapid fire tonight's edition of the Lightning Round. So stay with Cramer. The S&P 500 just wrapped up its fifth straight winning week. But recently, we've seen the rally broaden out to include all different corners of the market. How much I love that. I want to make sure you home gamers, I want to be sure you're taking advantage of this recent run because it is an incredible one. That's why tonight we're playing Am I Diversified? And this is where you call me, tell me your top 5 holdings. I tell you if your portfolio is diversified enough. Hey, maybe you need to mix it up a little. That ain't so bad. We just want to get you to be focused on many different sectors. So, Dennis in Michigan, you're our first caller. What do you got for me?
Jim, how's it going?
Oh, man, it's a great day here. Thank you. How about you?
Yeah, things are doing really well. Thank you.
That's what I want to hear. How can I help you?
Yep, club member here, by the way, and kudos to your excellent staff here and at the club.
We have an amazing staff. That's how I couldn't do all this stuff. I'm 5 people because my staff's a force multiplier. So go ahead.
Okay, 5 holdings are Uber, Broadcom, Eli Lilly, Energy Transfer, and Palo Alto Networks. Jim, am I diversified?
Wow. Okay, let's look at this. All right, Broadcom, it hit an all-time high earlier this week. Didn't today, interestingly enough, really up really nice. So we have, let's call it networking equipment. We have drug company. Uber Transportation, how about the way that soared on the idea that maybe the cyber mobile is not so special after all? Now, this gets interesting. Palo Alto. Well, let's do energy transfer. We had that last night. It's Kelsey Warren. I invited him on the show because it turned out that he made a lot of deals, but it's doing very well. So we have oil and gas. We have networking. We have drug. We have transportation. Now, so the question is there an overlap between Palo Alto and Broadcom? Do you know that Jeff Marks and I handled that this very morning on our morning meeting, and we said that this is actually a different part of technology, and it's fine. So I'm going to say cyber tech is not the same as networking tech, and that portfolio is therefore excellent. I like that. All right, now let's go from Pete in Delaware. Pete.
Hey, Jim. Thank you so much for taking my call.
Okay.
Also wanted to wish you a great weekend and hope you have a great time.
Well, thank you. Same.
Of course. I wanted to ask your opinion about some of my holdings that I think are getting a little bit top-heavy.
Okay.
The holdings are Advanced Drainage Systems, ticker WMS.
Yeah, no, that's a good stock. That's a good infrastructure play.
LeMaitre Vascular, LMAT.
Speculative. Okay.
Chubb Limited, CB. American Tower, AMT, and Bluebird Corp, BLBD.
No, this is the bus, not the bio. The Bluebird. That's the vehicle, not the bio, because Bluebird bio is gone.
Yes.
Yeah. Okay. So transport, very speculative bio. Insurance company was referenced this morning by Larry Fink as being one of the best in the world. I think it's important. Evan Grieber's doing an amazing job. This is a infrastructure play that I like very much. This is the worry here. I heard this week that they are not renewing enough towers, that the tower business, I'm not renewing enough contracts with the telco companies. So I'm worried about that, even though it's a diversified play, because you have telephone and you got infra, you have insurance, you have bio, and you have transport. But I don't want you in this American Tower, and I've liked it for a long time, but I'm now worried about it. The rest of it can stay as long as you recognize what a speculative play you have there. Joseph is up next. Joseph in New York, what do you got?
Hey, Jim. Booyah. My wife Marilyn loves the word diversified. I want you to tell us if we are. I've had these holdings for a long time. They are AbbVie, American Electric Power, Energy Transfer, HBAN Huntington, and NVDA.
NVIDIA. All right. So American Electric Power, we know that's the king. That's been our favorite transmission company for years and years. After we decided that we thought Dominion was not as safe as Electric Power. Huntington, we have that company all the time. They do just a fantastic job, and it's a good yield. We mentioned it was a good yield earlier. Steve Steinhardt doing a terrific job. And transfer again, that's Kelsey Warren, good job too. You got 8% yield, 7% yield. You got a little bit more than 4% yield there. NVIDIA, which is maybe the greatest growth story of our lifetime, and then AbbVie, which is a quintessential, terrific company that was split off from Abbott, which we recommended this morning in our morning meeting. This is the pharmaceutical side of the old Abbott Labs. So we've got pharma, we've got tech, we have oil and gas, we've got power, and we've got a bank. And so Joseph is completely in the clear, no possibility of overlap. I really like that portfolio. Hey, why don't we head West Coast with Jim in California?
Jim, how you doing? Jim in California.
Thank you, Jim.
Happy Friday, booyah. First-time caller, long-time listener.
Excellent. Thank you. That's what we want. Bring people in.
Yeah. My 5 stocks are Costco, Amazon, Apple, Health, NVIDIA. I need some of that Cramer magic. Am I diversified?
All right, let me see what I got there. Let me see if I can be the sorcerer's apprentice. Okay, so Costco is down a lot today. I almost wanted to put an alert to club members saying, hey, listen, you're not going to get another breaking Costco down here like this. Maybe you want to take some Apple, own it, don't trade it. NVIDIA, own it, don't trade it. These are difficult because we know that there's not as diversification, but I'm stuck on the own it, don't trade it. I'm not going back on that. I'm going to trump diversification with own it, don't trade it. Amazon, I'm going to call it a retailer that gives us room to be able to have it. And ELF, the stock has been very, very rocky here. I don't understand. It feels like a raid down short, but if there's obviously a Chinese component, that's where they make their stuff. So if you have a President Trump, then you have to believe that their gross margin is going to go down. Cosmetics, retail, oh man, what do we do? We like this tech. This is troubling, but you know what? Because it's a Friday, it's special, I'm going to grant permission to own both Costco and Amazon. And have a great weekend. Man, money back into the break.
Coming up, hit us with your best shot. An electrified fast fire lightning round is next.
It is time. It's time for the lightning round. Encouragement, everybody. We're wrap our calls. When you say in the stock, set up by Vice. Also, so just put it to the core stock, which is edit that my staff press the clear for the play. You play the sound. And then the lightning round is over. Are you ready, Ski? That's over the lightning round, Christopher. Let's go to Joe. In for Joe.
Jim, good afternoon and Happy New Year. How are you?
Oh, thank you. Same to you, sir. And I am doing fine. And just great to talk to the callers today. How can I help?
Yeah. Hey, look, I'm anxious for next week's monthly meeting on Wednesday. So
thank you.
I'm getting my question ready and getting it be prepared to send off to you and Jeff. So
please
thank you for doing that
so
for us.
Thank you for mentioning it. It's
regular
a big deal
investors. My stock is Boeing, Jim. You saw the big news this afternoon, 10% workforce reduction by Kelly Ortberg. Their stock's at a 7-year low stock price. They got a strike going on into month 2. They haven't had a profit since 2018.
I'm worried, Joe. I'm worried. Let me tell you why I'm worried. Because the balance sheet's not great, and they should have raised capital when they had a chance to. This was a very jarring series of news tonight, and I don't have any conviction whatsoever that they are getting this right. And I have to just be out there as one of the major things we have to watch for real trouble in the next few months. Let's go to Gian in Florida. Gian.
Hey, Jim. Booyah. This is Bharti Patel from Homestead, Florida. Here I have my grandson, Gian, who is also in your CNBC Investing Club, who has a question for you.
Sure.
Hey, Jim, booyah.
Booyah, Gian. What's shaking?
What do you think of Palo Alto Network?
Oh, Gian, that's a good one. Nikesh Arora, CEO, is out there talking about the stock, doing a roadshow. Wish he'd dropped by. I would have definitely bought him like a bottle of water or something. I think that Palo Alto is sensational. And let me just also say, I think George Kurtz does a great job with CrowdStrike, too. So you got 2 winners there. And this kid's got, write this down, I'm looking at Regina Gilligan. She's my executive producer in charge of everything. And I just want to say that kid's got horse sense. There you go. Let's go to Frank in New York. Frank.
Is this Jimbo, the king of the chill Cramer?
Yeah, I am chilling. I am chilling so hot, it's amazing. You can't really do what I'm doing. What's happening?
New York? Great.
What do we need?
All right. Well, I'm looking at JCI. Johnson Controls.
Can you believe that company's made such a comeback? I'm going to do you a 3-fer because I am in a good mood here. I like Carrier, I like Train, and I like Johnson Controls. Boom, boom, and boom. Can I speak to Tim in New Jersey, please, Tim?
This is Tim.
What's happening? It's Cramer.
What's up, Fulton Financial? What do you got? Regional bank.
They bought a couple of regional bank. Bought a regional bank in Philadelphia. Apparently, they're doing quite well with it. I think that's a good one. I wish it had a 4% yield. I'd feel better about it. And that, ladies and gentlemen, on the Lightning Round.
The Lightning Round is sponsored by Charles Schwab. Coming up, Cramer got a jolt of optimism this morning, and he shares it ahead of the weekend. Next.
Good evening, Mr. Cramer. Thank you. Thank you for everything you do.
You've been such a wonderful source of information with your teachings. I have to say thanks.
Thank you for all your advice and saving us from ourselves.
Your advice let me quit a job that I hated. I love you to death. Thank you for everything you do. Thanks for making us money. And more importantly, thanks for keeping us from losing money.
Larry Fink is pure joy. You may not know Larry, but you should. He runs BlackRock, which is the largest repository of people's wealth on Earth, with $11.5 trillion in assets under management. That's right, trillion with a T. Having grown an astounding $2.4 trillion just in the last 12 months. Larry visited with us this morning on Squawk of the Street, and as always, he brought his brand of what I call rigorous hope. What do I mean by rigorous hope when I say that? The man's an optimist. Someone who sees the glass a little more than half full. But he recognizes that we have lots of warts on the face of capitalism, too. He talked about how our nation, for instance, has way too much debt.
At the end of 1999, we had an $8 trillion deficit after 220 years as a country. 8 trillion, and today we're close to $37 trillion. We added, close to $29 trillion in 24 years. This is at an unsustainable pace. And if we are going to continue to be doing this, I think we are really mortgaging our future.
I don't know about you, but I found that chilling. We try not to think about the national debt because it's not a problem for the stock market as long as inflation is under control. But sooner or later, our political leaders need to get a handle on this situation. He's not in agreement with the government's prosecution of Google and reminds us how these big tech companies are the key to our relative strength against China. Not a popular position in Washington right now. But he says he likes these companies and finds it odd that we're questioning their scale, especially given the opportunities they offer. These are our national champions, for heaven's sakes. Larry is at his best when he talks about the joys of business, something he knows a lot about. After all, he built a company that pioneers so much of what's good about the markets. The accumulation of wealth through prudent investing in the company's amazing products, the public and private partnerships to build out our infrastructure, perhaps soon the dominant form of investing capital around the world. I know BlackRock itself has been an incredible investment. We put it in our bullpen for the Charitable Trust. Hope to add it maybe to the portfolio next week when we hold our monthly meeting on Wednesday. We told people who follow the Home Stretch Club Bulletin this afternoon that the results this morning were strong. Revenues up 15% year over year, $1.06 earnings beat off a 1040 basis. The investment management and financial service business saw a surge of net inflows, $221 billion in this quarter, nearly double $127 billion that Wall Street expected. That's extraordinary. So even though the stock's up more than 21% for the year, you know what? I still think it's got more room to run. Fink has probably done more to help people save money than anyone in our lifetime, with lots of different offerings from ETFs, well-tailored funds, even crypto. As he says, quote, we believe the model portfolio solution we are building will democratize retail access to private markets, end quote. Perhaps most important, he wants people to get started early in investing if they're going to have enough money to live later in life. As he told us,
we also need to have a conversation about retirement. And the sooner we can have a literate, educated conversation about retirement, we could fix it. But if we're going to deny the conversation about retirement and preparedness for retirement, we're going to have a bigger and bigger problem, like our deficits are in this country today.
What can I say? He's right. If you haven't started investing, what are you doing, for heaven's sake? And if you want to learn more, go read Larry's annual letter. I think it's fantastic. So many worship at the altar of Warren Buffett in his annual letter. I get that. He's earned it. But Buffett offers a different kind of, say, folksier optimism, one that often makes me feel like that almost nothing can go wrong. That's not Larry's style. He tells it like it is, and that means we need to fix things like the deficit, or they're going to overwhelm us. He's no Pollyanna. But he does offer a way out, a growth path of public and private investment, coupled with more fiscal discipline from Washington. Will it happen? Don't know. However, his individual advice stands. If you want to cope with any potential hardship down the road, you need to invest now. Save now. Let the power of compounding do the heavy lifting for you. That way, if, say, heaven forbid, Social Security benefits ever get cut in the next 10 or 20 years, a true nightmare, you'll still be fine. Larry's right. Let's get started. I like to say there's always a bull market summary. I promise I'll find it just for you right here on Mad Money. I'm Jim Cramer. See you Monday.
All opinions expressed by Jim Cramer on this podcast are solely Cramer's opinions and do not reflect the opinions of CNBC, NBC Universal, or their parent company or affiliates, and may have been previously disseminated by Cramer on television, radio, internet, or another medium. You should not treat any opinion expressed by Jim Cramer as a specific inducement to make a particular investment or follow a particular strategy, but only as an expression of his opinion. Cramer's opinions are based upon information he considers reliable, but neither CNBC nor its affiliates and or subsidiaries warrant its completeness or accuracy, and it should not be relied upon as such. To view the full Mad Money disclaimer, please visit cnbc.com/Mad Money disclaimer.